Hello and welcome to AI Market News by LM. This week, we're diving into the huge wave of optimism that's been hitting the global markets. And what's the catalyst? Well, it looks like we're finally seeing a potential end to the longest ever US government shutdown. We're going to break down what's happening, what it means for investors, and what we should all be watching next.
Okay, let's jump right in. There is a massive wave of optimism just sweeping across markets everywhere. And honestly, it's all being driven by this one single event, a breakthrough to finally end that historic US government shutdown. This isn't just a political headline, folks. It's the thing moving asset prices right now.
And that optimism got a huge jolt of energy when President Trump came out and backed a bipartisan deal. That signal of support made it seem incredibly likely that the government would be back up and running within days. For the markets, that was the green light they'd been waiting for. So what does this path to reopening actually look like? Well, after 41 long days, the gears in Washington are finally starting to turn. First up, the process kicked off in the Senate, which already passed a key funding bill. Next, the House has been called back for a vote that we're expecting on Wednesday. If everything lines up, the shutdown could officially be over as early as Thursday.
So what happens when this kind of political news hits the street? Well, it immediately triggered a major shift in how investors are thinking and acting. We're seeing a classic risk-on rally, where that cloud of uncertainty starts to fade, and traders feel confident enough to move their money into assets with more growth potential.
Let's break down that shift, because it's really interesting. What we're witnessing is a textbook rotation of capital. Money is flowing into things like equities, especially those growth-oriented tech stocks. At the same time, we're seeing currencies that are tied to global growth, like the Australian dollar and the Chinese yuan, catch a bid. And on the flip side, investors are selling off those so-called safe haven assets, like government bonds and US Treasuries, which, by the way, is also putting some pressure on the US dollar. And we can see this in action when we look at the actual numbers. The small negative change here in S&P 500 and NASDAQ futures, well, that might just suggest a little profit-taking after the first big jump. But look at the currency markets. We can see the euro gaining a bit on the dollar. The one that's really telling, though, is the rise in the USD/JPY pair. That shows investors are selling the Japanese yen, a traditional safe haven currency, and that just confirms this whole risk-on mood. But here's a thought. Beyond just looking at prices going up and down, how can we actually quantify this wave of optimism? I mean, is there a way to measure the collective emotion that's driving all of these trading decisions?
It's a great question, and it turns out there are ways to do it. Analysts use some really clever tools to get a read on the market's psychological state. They're basically trying to figure out if investors are acting more out of fear or out of greed.
Now, one of the most popular tools for this is the Fear and Greed Index. The logic behind it is actually pretty simple. When investors get too scared, they can push stock prices way below their real value, which might create some buying opportunities. And on the other hand, when greed totally takes over, it can inflate prices into a bubble. You can almost think of it like a thermometer for market emotion. Now, what's really cool is how this index is actually built. It's not just one number. It's a mix of 7 different indicators all rolled into one. For example, it looks at market volatility using the VIX, which people often call the fear gauge, to see how much panic is out there. It also compares the demand for risky junk bonds versus super safe treasury bonds to see if investors are chasing risk or running for safety. By combining all these signals, it gives us a much more complete picture of what's really driving the market.
Okay, so with the shutdown issues seemingly wrapping up, the market's focus is now pivoting hard to the other major force that can move prices: central bank policy. Specifically, what is the US Federal Reserve going to do next?
And the really crucial point here is that the shutdown created this kind of data fog. For weeks, really important economic reports just weren't released. Now that the government is reopening, we're about to get a whole flood of delayed data, especially on things like inflation. And that information is absolutely critical for the Fed to make its next call on interest rates.
And it seems like there's a pretty active debate going on inside the Fed itself. We're hearing different things from different policymakers. As seen in the provided information, San Francisco's Daily has warned about keeping rates too high for too long, while others, like St. Louis's Muslim, are urging more caution. This tells us there's no clear consensus on the path forward.
So, this internal debate at the Fed leads us to the million-dollar question, right? If the policymakers themselves seem divided, what does the market, the collection of all of us traders and investors, actually think is going to happen?
Thankfully, we have a tool that gives us a real-time answer. It's called the CME Fed Watch tool. and it analyzes the futures markets to figure out the probability of a rate change. And right now, it's showing that bets on a future rate cut are actually increasing. Traders seem to be anticipating that the Fed might need to step in and support the economy.
Okay, so let's bring it all together and look ahead. With the shutdown ending and all eyes on the Fed, these upcoming economic data releases are going to be more important than ever.
Taking a quick look at the economic calendar for today, U.S. time, there are 2 key releases to watch. First, at 6 a.m., we get the NFIB Business Optimism Index, which tells us how small businesses are feeling, a great indicator for the broader economy. Then at 8:15 a.m., we get the ADP Employment Report, giving us an early look at the health of the job market. These reports will be some of the first hard data we've had in a while to help us see through that data fog.
And all of this brings us to the final critical question. The market has rallied hard on the good news of the shutdown ending. But with the Fed's next move still up in the air, the big unknown is whether the economic data will actually be strong enough to justify all this newfound optimism and keep the rally going. That is what everyone will be watching.
This video was automatically generated by NotebookLM, an AI-powered tool. The reference sources used in this summary are listed in the video description. As this content is AI-generated, there may be errors in proper names, pronunciation, or unnatural speech. This video does not provide investment or trading advice. Please make investment decisions at your own discretion. Thanks for watching. Don't forget to like and subscribe.